Introduction to Accounting and Business. A business is an organization in which basic resources, such as materials and labor, are assembled and processed to provide goods or services to customers. The resources are considered to be inputs. The goods and services are considered to be outputs. The objective of most businesses is to earn a profit. The profit is the difference between the amounts received from customers for goods or services and the amounts paid for the inputs used to provide the goods or services. So basically saying that revenue minus expenses equals net income, or the profit. There are several different types of businesses. We have service businesses, merchandising businesses, manufacturing businesses. Service businesses such as Delta Airlines offer transportation services, while the Walt Disney Company offers entertainment services. Merchandising businesses like Walmart have general merchandise, while Amazon.com offers internet books, music, and videos. Manufacturing businesses such as the Ford Motor Company creates cars, trucks, and vans, while Dell Incorporated creates personal computers. Accounting can be defined as the information system that provides reports to users about the economic activities and condition of a business. The process by which accounting provides information to users is as follows. We identify the users. We assess users' information needs. We design the accounting information system to meet the user's needs, record economic data about business activities and events, and prepare accounting reports for users. So let's say, for instance, that we identify a user to be a department manager. Well, that department manager's information needs would only be information about their particular department, whereas a general manager needs to know information about everything, of course, as well as the owner. Now, the general manager needs to know profit and loss reports for different departments, but the owner of a company would need to know things such as the balance sheet, the owner's equity, as well as the profit and loss. So each user has its own information needs. Now, in managerial accounting, the area of accounting that provides internal users with information is considered to be managerial accounting or management accounting, almost always referred to as managerial accounting. Managerial accountants employed by businesses are employed in private accounting. The area of accounting that provides external users with information is called financial accounting. The objective of financial accounting is to provide relevant and timely information for the decision-making needs of users outside of the business. General purpose financial statements are one type of financial accounting report that is distributed to external users. The objective of accounting is to provide relevant, timely information for users' decision-making. Accountants must behave in an ethical manner so that the information they provide users with will be trustworthy and thus useful for decision-making. Ethics are considered to be our moral principles that guide the conduct of individuals. And as we all know, not everybody is very ethical. Accountants are held to a higher standard just like lawyers are. So if you do something that's considered to be unethical, you basically ruined your career as an accountant. You have to be very careful about the things you do in accounting. Now, several different companies have already been cited for fraud, and we're just going to take a snapshot of these right now. AIG, American International Group, they use sham accounting transactions to inflate performance. Well, this is considered to be fraud and unethical. The CEO had to resign, and executives were criminally convicted, and AIG had to pay $126 million in fines as a result of using sham accounting transactions. Basically, what they did is they created transactions that were not real to make it seem like the company was performing better than it was. The people who lose out in the end are the ones who invested in the company. Those are your investors. Computer Associates International Incorporated fraudulently inflated its financial results. The CEO and senior executives were indicted, and 5 executives pled guilty and had to pay $225 million in fines. We've all heard about Enron. It fraudulently inflated its financial results. As a result of all this, bankruptcy happened. Senior executives were criminally convicted. Over $60 billion was lost in the stock market. Enron hurt a lot of people, from investors to the owners to the executives. And unfortunately, at least one suicide, I believe, came out of that. And that's an unfortunate thing. However, when you act in such an unethical way and you start stealing money from people, society looks down on you in a very negative way. Fannie Mae improperly shifted financial performances between periods. The CEO and CFO was fired. The company made a $9 billion correction to previously reported earnings. We are talking about millions and billions of dollars here. This is money that majority of us in a lifetime could not even fathom. So the fact that these companies are fraudulently having transactions or creating them and doing the things that they're doing and these amounts of money, obviously this affects more than just the company. Health South overstated performance by $4 billion in false entries. Quest Communications International Incorporated improperly recognized $3 billion in false receipts. Satyam Computer Services significantly inflated assets and earnings. T-Rex Company recorded profit prematurely inflated the profits. Tyco International failed to disclose secret loans to executives that were subsequently forgiven. United Rental inflated profits to meet the earning forecast and analyst expectations. And the Xerox company recognized $3 billion in revenue prior to when it should have. All considered to be fraud. All resulted in either fines being paid, people being convicted, or people having to resign and being fired from the company. Now, when we talk about ethical behavior, there's some things that we must talk about. We want to answer what went wrong for these companies that were involved in all of these factors. Failure of individual character, firm culture and greed of ethical indifference. Guidelines for ethical conduct. You must identify ethical decisions by using your personal ethical standards of honesty and fairness. If you're not an honest and fair person, you're going to have a really hard time making ethical decisions. We must identify the consequences of the decisions and how it affects others. You must consider your obligations and responsibilities to those that will be affected by your decision. And you must make a decision that is ethical and fair to all of those who are affected by it. Again, if you're not an honest and fair person, you're going to have a hard time making ethical decisions. And one of the things you probably want to ask yourself, if you make this decision and you act upon it and you had to stand in front of the whole world and own up to it, how would you feel about yourself once you did this? That should help you a lot in making ethical decisions. Now, there's a lot of opportunities out there for accountants. Accountants and their staff who provide services on a fee basis are said to be employed in public accounting. Accountants employed by a business firm or a non-for-profit company are said to be employed in private accounting. Public accountants who have met a state's education, experience, and examination requirement may become a certified public accountant, commonly known as a CPA. Private accounting, there's a lot of career options here. You have bookkeeper, payroll clerk, general accountant, budget analysis, cost accountant, internal auditor, information technology auditor, starting in ranges from $36,000, $34,000, all the way up. Public accounting, we have local firms and national firms. Nice salaries there. Financial accountants follow what we consider to be the generally accepted accounting principles, GAAP, G-A-A-P, in preparing reports. With the U.S., the Financial Accounting Standards Board has the primary responsibility for developing accounting principles. The Securities and Exchange Commission, the SEC, which is an agency of the U.S. government, has the authority over the accounting and financial disclosures for companies whose shares of ownership, stock, are traded and sold to the public. Many countries outside of the United States are generally accepted accounting principles adopted by the International Accounting Standards Board. Under the business entity concept, the activities of a business are recorded separately from the activities of its owners, creditors, and other businesses. A proprietorship is owned by one individual. 70% of business entities in the U.S. are proprietorships. They're easy and cheap to organize, and the resources are limited to those of the owner. These are generally used by small businesses. A partnership is similar to a proprietorship except that it is owned by two or more individuals. 10% of business organizations in the U.S. combined with the limited liability companies or partnerships combines the skills and resources of more than one person. A corporation is organized under state and federal statutes as a separate legal taxable entity. This generates 90% of business revenues. 20% of the business organizations in the U.S. are made up by corporations. So 20% of the businesses in the United States generate 90% of business revenues. Ownership is divided into shares called stock, and this can obtain large amounts of resources by issuing a stock. These are generally used by large businesses. However, one-owner companies can also be incorporated, and generally they will flip over to what's considered to be an S Corp, which is a subchapter corporation, and it's considered to be a pass-through entity into their personal taxes. So not just large businesses can be corporations, even one person can incorporate their company. A limited liability company, known as an LLC, combines the attributes of a partnership and a corporation. 10% of business organizations in the U.S. are made up of limited liability companies. This is combined with partnerships. Often used as an alternative to a partnership, because a partnership can be worse than a marriage. If you go into partnership with somebody, you better make sure you know them better than your spouse. LLCs has tax and legal liability advantages for the owners. Now, we have what's known as the cost concept, and under the cost concept, amounts are initially recorded in the accounting records at their cost or purchase price. So whatever you paid for it, whatever the cost was, is what you will record that asset for in the books. For example, Aaron Publishers purchased a building on February 20, 2010 for $150,000. Other amounts related to this purchase are shown on the next slide. Price listed to by the seller, $160,000. Aaron Publishers' initial offer to buy on January 31st, $140,000. Purchase price on February 20th, $150,000. Estimated selling price on December 31st, 2012, $220,000. And the assessed value for property taxes on December 31st was $190,000. Now, we're going to record this building at $150,000, not any other amount that's shown here. None of these amounts are relevant to what we recorded. It was purchased for $150,000, and $150,000 is what we were recorded at on the books. The objectivity concept requires that amounts recorded in the accounting records be based on objective evidence. Objective evidence is source documents. Source documents are receipts, bank statements, invoices, bills, credit card receipts, any type of document that indicates that there was a transaction that happened. And let me be very clear with you. If there is not a source document, then you cannot prove the transaction happened. So for every transaction in your accounting system, there better be a source document to back it up. Only the final agreed upon amount is objective enough to be recorded in the accounting records. We have a unit of measure concept that requires economic data to be recorded in dollars. Now let's look at an example of the cost concept. On August 25th, Gallatin Repair Service extended an offer of $125,000 for land that had priced for sale at $150,000. On September 3rd, Gallatin Repair Service accepted the seller's counteroffer of $137,000. On October 20, the land was assessed at value of $98,000 for tax purposes, and on December 4th, Gallatin Repair Service was offered $160,000 for the land by a national retail chain. At what value should the land be recorded in Gallatin Repair Service records? It should be recorded for $137,000 because under the cost concept, the land should be recorded at the cost to the Gallatin Repair Service and no other amount.